In today's training, again, we're going to cover the module 4, which is really focused on the functionality around certain areas of the underwriting model. We're going to look at the pro forma expenses, tax analysis, payroll analysis, the GP split, and the summary reports. I also have one thing that I want to throw in there, which is the expense database, which helps with your expense analysis. So we'll go ahead and get right into it. In a prior training, we covered mapping the T12. So once the T12 is mapped, the values there are visible for you in this section. And you can toggle between a T12, T6, T3, and T1. That is just taking, a T6 is just taking the last 6 months of expenses and converting that into a full year of expenses, basically multiplying it by 2. Same thing with the T3 and a T1. It's just annualizing that number. And this does not impact your underwriting whatsoever, but it's helpful to provide a visibility into how the property is operating today, so that when you plan your year one pro forma, you kind of know what operational efficiencies you could go after or how the property is performing. Um, and so the idea is that when you do your expenses, you'll really set your individual line item expenses for the year one pro forma. And then year 2 and beyond are really just escalated using your expense growth value below in the growth rates and percent GPR assumptions section. If you wanted to, you can always overwrite any of the year 2 or beyond expenses with your own values. Okay, so you can always just go into here, override it. If you do that, I do recommend highlighting the cell in yellow so that you know you put a manual edit in there, because you could get tripped up down the road if you forget. In each of the expense, I put a rule of thumb. Now, this rule of thumb is just a very broad-based rule of thumb. Of course, the location of your asset, the asset class that you have, even the submarket and MSA. These are all huge factors, and the size of the asset are huge factors in your expenses. So these are rules of thumb just as a guideline, but I would strongly encourage you to kind of like research your area. As you underwrite more deals in a particular area, you will get much better at gauging your expenses and what the property can do. And then, as I've said before, is once you come up with your pro forma, and if the deal makes sense and you're really looking to pursue it, talk to your property manager or have a relationship with the property manager in the area. This is their expertise. It's very helpful to get another set of eyes on your expenses. And even sometimes your lender, as you get a debt quote, will have a pretty good idea of the expenses for that type of asset in that market if they do a lot of loans. So you always get another set of eyes on this. But for your initial pass, really just looking at how's the property performing, what do you think you can do to either carry the expenses the same or improve them, or in some cases like taxes, if the property is going to be reassessed, if you know it's going to be reassessed, your tax value you'll need to adjust. Insurance, you'll usually get a debt quote or insurance quote, sorry, and put that value in here. So that's kind of a guideline. So what I wanted to show you real quick is the expense database. This is what I call like the beta expense database. I find this very helpful. It's completely optional. But what I do is if I map, let's say, a T12 into the MFA, and it looks like that property is operating well, and I want to capture those expenses, the income and expenses. I want to be able to capture that so that I can reference back to that as I underwrite more deals in that market to get a gauge for the expenses in that market or the income. So I want to show you that real quick, and then I'll show you how to use it. So come on. Okay. This is the expense database. I'm just going to show you the output real quick, and then I'll explain how to update it. So what I do is I capture. So and lately there's a lot of deals out there that we're looking at that are not operating well. They may have very high expense ratios, very high vacancies, things like that. I don't want to capture those kinds of properties. I really want to capture properties that I think are being run well, because that's kind of what we're going to strive for when we underwrite, right? And so I capture all that data. So over, I don't know, maybe a little over a year, I've imported 75 properties. Average unit size is 205 across all those 75 properties in across 67 cities that we've looked at. And what this allows me to do, if I just want to come in here and let's say look at Georgia, right? I can filter this for Georgia, and you see all the MSAs that I've looked at for Georgia. And let's say I want to look just specifically to the Atlanta market. Okay. So in the Atlantic market, I've uploaded 15 properties across 12 cities within the Atlanta MSA. But now what I can do, as you can see, payroll is averaging, let me just make it a little bigger for you. Payroll is averaging about $1,500 a unit, right? That's a pretty good guesstimation, right? So now as I underwrite, I'll look at how the property is performing versus how the average of these properties is. And then I'll look at what do I expect it to do in year one, right? So it just gives me another set of data to kind of evaluate the performance of the property I'm underwriting. And this is pretty easy to update. I'll kind of just walk you through that real quick. So in the MFA, there's a hidden tab. It's called Expense DB. So if you just right click on any tab in the MFA, you go unhide, and you can see there's this Expense DB tab that's hidden. Just go ahead and unhide that. And what this does is it just pulls all your year one or all your T12 data as it is in the underwriting model. You want to pay attention to a couple fields because not everybody is great about filling out these fields, but it is important for the expense database, which is what is your date of analysis, what city, MSA, and what is the state? These are really important because it helps with the filtering of the expense database. But let's say you're good with that. You just copy values. You just click that button, go into the expense database, and there's an input tab. And then just click the button that says paste values. So just paste it in all the values from that tab. And then I click save to database. And what this does is it's I call it a database. It's really a table in this Excel worksheet, and it's just writing all these values into that table in a format that we can analyze it using the output tab, which is a pivot table. And of course, because I'm on Zoom, it's taking very long. But usually this writing process it takes like 2 seconds typically. So data saved. And then what I could do is come to output. Let's go and unfilter. I forget what let's see. Oh, I got to refresh. Sorry. So once you're done, you just refresh the pivot table. So you right click anywhere on the pivot table, click the refresh. And what that does is it updates the pivot table with the data that we just wrote. So forget what I called it. MSA Anytown. There it is, Anytown. So this is the one I just added to the database. Oh, look, I've added it a few times as I've practiced, right? So this is my working file. But there you can see it's in there, Anytown, USA. I forget what town, city, California. So this is the one I just uploaded. So that's pretty much it. And now I can use this, I can refer to it as I do my underwriting process. So this is available to download on the site. Again, it doesn't have the data filled out. So as you build your own database, right? As you underwrite deals, you find T12s that make sense. You want to add it to the database. This would be the process to do that. And over time, you'll start to amass quite a lot of properties if you're pretty active. All right. So that is that. Okay. The couple large expense items I want to talk about that have supporting worksheets. One is the payroll. So this always kind of bothered me is like everybody just used kind of this random number like 1200, 1400. But I kind of wanted to do a deeper analysis and say, well, if we have 4 people working at the property, what does that mean? Because obviously the cost per unit changes depending on the number of units. So I created this payroll worksheet. I put some kind of guidelines on the right that you can refer to. But here you can actually do the analysis. Say I have one number of staff. The average salary is 52,000. We're going to give a 10% bonus annually, on average. And then you have a burden rate. So you have the administration. So this is often referred to as the in and the out. So the staff that's in the office and the staff that's outside the office, which is the maintenance outside. And so you can kind of make some assumptions. I'd say in maybe a third of the OMs that I look at, they may have a payroll indicated in the OM. So they'll tell you what staff is on site. So that's kind of helpful for this. And then you can get a cost per unit. So our goal with this worksheet is to get to this 1426, this cost per unit. So once you have that, you can click this, go back to the underwriting model, and now you can toggle this on or off, right? So right now I have 1200, but after our analysis, we knew that it's probably going to be closer to 1400. So you toggle that on and it populates with what was on that payroll worksheet. And you can toggle this back off if you don't want to use that. And it will put back in your value that you had before, which is 1200. So that's the payroll. The other one is taxes. Taxes are huge, right? I think it's very important to get taxes correct. This is most often, I'd say nearly always, your largest expense. And it's the one that can change most dramatically after you take over the property, right? So if there's a reassessment and the valuation of that property is higher, you can expect a higher tax bill. So it's important to spend time on your taxes. There's a tax worksheet in here. So what I would do is I go to this link here. This link gives you a list of all the taxing jurisdictions across the country. So you just pick your state and your county, and then you could go to that county's website and you can look up the property. Sometimes it's by address. Sometimes you got to determine what the parcel ID is. It's different for every county, but the goal is to get the current tax bill and if there is a current assessment. So, or from the appraiser, right? So you want to know what did they think the property is valued at and what was the last tax bill? And using the last tax bill, I've put in the valuation from that tax bill, the assessed percentage. So it's pretty obvious. You could see in a lot of tax bills. And then you got to calculate the millage rate. So this is sometimes harder to get on the tax bill because they'll break out the millage rate into 10 or 15 different things, right? And so that gets kind of, whoops, yeah, that gets kind of annoying. So what I do is once I have the appraised value in here and I have the assessed value, these will be very clear on the tax bill, I will back into the millage rate. So what I do is I use my trusty goal seek. I've showed this one many times, but in the what if analysis, in the goal seek, I can back into it. So I want to set this cell, the tax amount. So in the tax bill, we're going to know that the tax bill is 109,253 and 55 cents. So you can look at the tax bill, you'll know that value, and I want to change the millage rate to get to that. So I click OK, and then this will back into the millage rate for you. Makes it very easy instead of adding all those millage rates up. So what this does for me now is like I can say, well, it's also very important to say in many cases to call the assessor, tell them you're interested in buying a commercial property in the area. What is their process for performing a reassessment? Some of them won't actually reassess on sale. They might have a certain cadence. Maybe it's every third year they do a reassessment. Then you want to understand at what year in that cycle they are in. You need to understand their taxing strategy. But if they, in this case, let's say they assess on sale and they will most likely assess to the purchase price. Again, it depends very much on location. But in this case, I could say, okay, they're going to assess on sale. We've underwritten the deal. We have a 16.5 offer price using this 40% assessed value and the millage rate. We can expect our tax bill to go to $200,000. This is up from 109,000. All right, so this is a calculation, a way of calculating your tax on your property after you take over. And let's say in this situation, let's say we expect another reassessment at year 3, right? So you could come in here and you could say, well, my property value will be 20% higher in year 3. I'm going to go and put that in, and now we can bake in some kind of tax escalator. Now, this is a little bit harder to predict what's going to happen in the future. There are companies that will perform, that are very knowledgeable, that will perform a tax assessment on a property you're looking to buy, and they'll give you a very detailed breakout of year by year what they expect to happen. But this is good enough for our first pass of underwriting right here. Any questions on that? I know we kind of flew through that.
I don't have a question. I have kind of a comment. I noticed that a lot of the assessments also have a fixed additional fee, be it a stormwater fee or
Mm,
whatever, some kind of non-ad valorem tax rate that you've got to add on to that. So what I've been doing, and I don't know if this would be helpful to anyone else, but some of them are pretty significant. So what I do is just add that onto the formula after the
mm.
tax amount. Like I had one yesterday that I was working on. It had another like $3,750 on top of that. So I just kind of clicked on the formula and added plus 3,750 to it.
Good
I don't know
idea.
if that's the way you recommend doing it, but that's been
Yeah.
working for me. And I just wanted to point that out for people that if there is a significant fee, you want to make sure you account for that in addition to your millage rate.
Yeah, that's a very good point. And that's an excellent way to handle it, right? You could just kind of add it to the formula here if you want. Okay, great. So now we've done our tax analysis. How do we get this back into our underwriting? Because right now we just have this blanket number, 475,000. So what you can do over here is under the taxes section, just go ahead and click this to on. And what this is going to do, it's going to map your tax to your tax worksheet. So you can see tax year 1. This is going into the second year of taxes. And then remember on the third year, I had a bump in there because we expect a reassessment. So that is now captured in my underwriting. And then to say, nope, I want to go back. I want to just do it manually. You can. You don't have to use the tax worksheet. Puts back in the value that you had. And now what it's doing is it's escalating the tax amount by the growth rate assumption here. So you have a tax growth rate assumption right here. So it's 3%. So that's what it's doing now. So starting at 475, your manual entry, and then escalating by 3% each year. So you have a couple options for how you want to tackle your taxes. Okay, we're going to touch base very quickly on GP split. So I'm not going to go over a lot of these sections here. These are outputs only. Sorry, not that one. So like the non-operating expenses, it's an output. The debt, just based on your debt above. So, and the cash flow, I think is important. I don't see this in a lot of models, but I think I really like to see year by year what's happening with the cash flow. So I can see the cash flow from operations. I can see any cash flows as a result of a sale or refinance. And then I can see what's happening with the capital account. Like, are we paying the capital account off based on the sale, or how much are we paying on a refinance from the capital account? Things like that. So you can see all your cash flow. We have the returns and then the GP split worksheet. So this is entirely optional, does not affect your underwriting. But let's say you have um, several GP partners and you want to kind of model out how are we going to split up our partnership share of this project based on the task that each person is going to perform. So there's these large buckets of work, which is kind of like the pre-close work. So this is the acquisition, pre-close money, which is your at-risk capital, your balance sheet liquidity. So who has the experience and the liquidity and net worth requirements to take down the deal? And then your asset management, and then you can make your own categories below it, right? If you have an investor relations or whatever. These are just sample. So you can see I'm allocating 20% of the GP share to the pre-work, 20%, 20%, and then 40% for asset management. That's a larger piece. And then what you can do is you can break out each section. So for this example, I'm breaking out, looks like 6 partners. So we're talking pre-close work. Partner one's going to do most of the work. They get 50% pre-close GP split, which ends up coming to 10% of the total GP. And then you start breaking out the splits, and it breaks out the acquisition fee. If there's any cash flow, so this deal is not cash flowing. If there are any refi sale proceeds, um, fees, refi sale fees or refi sale proceeds, and then the total amount expected. So you can do this work for each bucket of work, right? You can break out the GP split, and then at the total level, you could see partner one, this just summarizes everything. So partner one is getting 23.6% of the total GP based on the work above. And you can see it kind of broken out here. And then you can see actual percent of the entire deal. So they actually are getting 7% of the entire deal. And then you can see the total fees that they're getting here. So play with the worksheet. It's very flexible, which makes it a little bit confusing, but the idea is that for each bucket of work, you're going to break it out between who's getting a percentage, or who's doing a percentage of that task, and then it generates the GP percentage and aggregates below. So if you have any questions on this, feel free to reach out. One thing that we've talked about in the past is if you are doing a JV deal, the best way to model that in this template is to set the cash on cash preferred return to 0 and then 100% GP split. And what that does is it bypasses the LP return section and puts all the cash flow into the GP bucket. And then you can use this GP split worksheet to break out your JV percentages. And we've covered that before. Okay, 2 more items, summary report and the DRC. So I'm going to start with the DRC. So this is the deal review checklist, right? This is just an output. The reason I created the deal review checklist is I wanted a standardized way to review each of the deals we look at with our internal team, right? So this is not really intended to be an investor report necessarily. It's more so, I've got this great deal. I want to present it to some potential partners, and this keeps me organized, right? So that we can cover all the important topics. It's pretty self-explanatory. It has this summary. So this is just a very brief underwriting summary. The pricing, the strategy, the debt, and the returns are all located here. I will list key opportunities for the property. I'll list the key risks, write a brief deal summary, and then this table really is just to capture any key decisions or action items as a result of our meeting so that we keep a record of that. And then you can see it's literally a checklist. The initial deal screening, did we talk about whisper price, offer price, right? So you could just go through and check these off, right? You just go down the list. If there are any decisions or comments or notes that you want to capture for each of these, you can. And it just goes through the financial analysis, business strategy, what financing are we putting in place, what's the exit strategy, physical inspection, what are the things we're looking for, market analysis, did we do our homework on the sub-market, operational assessment, and the risk assessment. So 9 basic sections that you follow. Again, entirely optional, but just a checklist to kind of help keep your thoughts and your discussion organized with your partners. If you want to send this deal summary to anyone, you just click this copy deal summary button right here. And what it does is it just copies a picture and image of that deal summary onto your clipboard so that now I can just paste it into an email or however you want to send it. Just a quick deal summary. Okay, and last but not least, we're going to look at the summary. So this summary is intended to be a little bit more of a maybe say like investor focus. So let's say you want to share, like some investors want a lot of detail, right? Sometimes they'll ask for the underwriting file. Sometimes, so what we tend to do, sometimes we'll give them screenshots of the pro forma if that's what they really want. But we find like this investor summary will satisfy the need for the people that really want more detail because it talks about a lot of detail. It shows a high level pro forma, the ratios, the business plan, the cost sensitivity analysis, the investment breakdown. It has a couple graphs. It's a fairly detailed, and it usually satisfies some of the needs that they have. So what I'll show you is there's one input really. So this area that's shaded, what I'll do is I'll typically put pictures right there, so it looks pretty nice. Has a list of pictures. So the way I do that is I would take small little screen clippings of the offering memorandum. So in this case, I just grabbed a random one this morning. So usually I'll take a couple exterior pictures, and then I'll take a couple interior pictures and organize them into that box. And it's pretty easy. It doesn't take very long. And I'll show you the process that I do that. So usually I want like some of the exterior amenities, usually a classic unit, and then renovated unit if there are any at the property. And what I'll do is I'll highlight all of them. So I do that by clicking on one, and then I hold the control key on my keyboard and I click the other pictures. And then what I do is I want to size these. So I'll go up to picture format and I'll do the height. It's on the far right, if you can see my cursor, and I'll set the height to 1.65. So that ensures the height fits in that little box really well. And it looks like I have too many pictures. I'm going to leave this guy out. And I'm just going to, what I do is I organize the first picture as far left. I put it right where I want it, really like as far left and kind of centered in that box. So that's going to be my anchor picture. And then I'll start organizing all these other pictures kind of in the order I want. So I want the classic unit here. Actually, I think I might have room. I'm going to bring in the other. So I'm trying to fill up the space very roughly from left to right. So I've got all these and then the renovated unit. So what I want to do here is I want to place the renovated unit just looking at the right edge. I don't care about the top. All these pictures need to be lower than your anchor picture. But I'll just kind of like size it like right there. That looks good. See that distance from the edge? Let me zoom in a little bit. Okay. And then again, I'll go through the process. I'll click one, hold the control key, click the other pictures. And then there's some really nice features for getting these aligned. So I'll go into the picture format tab above, and then I'll align the pictures to the top. And then again, I will align the pictures and I'll distribute horizontally. So it makes them all equal space. So you can see there's some overlap, and that's fine. I don't think that's a problem. And then sometimes, just because I like a little bit of differentiation between my pictures, I'll go to picture effects, I'll do a shadow, and I'll do an internal center inside shadow. And it just gives some kind of separation between these pictures. Just easier to look at for me. And that's it. So once the pictures are there, you can put a label over the top, and that's what these are right here, these picture labels. So it comes directly from your underwriting. So I could tell you, in this case, 11% of units, 16 units are upgraded. Okay, so I'll just right click on that. I bring it to front because I want this label on top of the picture. So I could do this. Maybe I'll put it at the bottom. Looks easier to read on the bottom. And then the classic unit, I right click on it. I bring that to the front because right now those pictures are on the layers. The pictures are in front. I want the label to show in the classic unit. So this is helpful for our investors, right? Because they know we're looking at the property and we know how many of these units are classic. That's a key part of our business plan. So we want to make sure that's really clear. Okay. And then you put your company logo in the top right, whatever you want to do, or just this is just an image. You could just delete it if you want. And then the last part is to send this. So how do we send this? There's a couple ways. You can copy summary right here. And what this does is it copies an image, kind of like it did on the DRC. And you could paste that image into an email. If you want, you can save this as a PDF. And the way to do this, and I'm not going to walk through this step because on Zoom, it will crush my computer. But what you do is you highlight the section that you want to convert to PDF. Okay. So just like that. And then the process is you print and then print to PDF. So you see the printer selection here is a print to PDF. That's what you want. And as soon as I click print, it will ask me where I want to save this as a PDF. And this is what it looks like. So it's a nicely formatted report. It'll save into PDF. You can send that PDF file with all this information. Okay. Any questions on this? A few minutes over. Cool. Oh, one other thing I'll mention, I forgot to mention is there's this GP earning tab. Oh, let me fix. So we're not getting any returns because I made it into a JV deal. So let me change that. There we go. So if you're sending this to limited partner, you probably want to remove your GP earnings portion. That part is not relevant for them. And you can do that by toggling this drop down to yes, which means exclude the GP and project earnings. So there you go. So now the returns are just showing the LP or the partner earnings. And if you toggle back to yes or no, don't exclude it. There you go. It shows the project level and it shows the GP. That's really all that does. Okay. I think that concludes our 4-part training module. Again, I have slipped. Forgot. I got busy and forgot that I have not uploaded module 3 that we covered last time. I'll work on that and then I'll work on this one and get it uploaded as well. Okay, that is it for the module. Are there any opens? This will be our just open Q&A. If you want to talk about anything, ask any questions.
Craig, I joined a little late. I did notice that the version that you're working off of is a little bit newer than the one I
Yeah.
had. That had the 4.1 is the
4.1,
4.2.
yep.
Yeah. Is that already uploaded? Or is this
Not yet.
behind the curtain type deal?
It's a behind the curtain. It's so what I do is I always create a working model and then that's the one I start to work on enhancements for. And then once I'm done testing it, I roll it out. So yeah, I am using the newer model. I'm not happy with the way the rent roll input. It's been very slow. So I've come up with a method to make it much faster. It's actually I tested it, it's 50% faster or just a little more than 50% faster. So I'm excited about that, trying to speed it up. But yeah, so this is just the next release that will come out hopefully soon. And then I've got a bunch of sensitivity tables that I'm working through right now. Good question. Any other questions? General questions, input, underwriting?
Just the pulse. I mean, can we talk a little bit just what we see the pulse of the market, what we're seeing in the underwriting? Any
Yeah. Yeah, I would say for our team, we've seen a significant uptick in deal flow, at least in the last month. Like a lot more deals hitting, still a little bit overpriced, but getting a lot closer. Like we've definitely put in a few more LOIs than we have been lately. And we're somewhat competitive, but we got outbid on a few. And it's very market specific. So we're noticing that South Carolina is still pretty hot. Like we're kind of surprised. Some of the deals that we're seeing trade are going for much more than we anticipate. And the only way to get there that we can figure is people are forecasting larger rent growth than we were. We actually had a very detailed meeting with one of the brokers where we reviewed our underwriting, and he agreed we were spot on, but that the team that won the deal was much more aggressive with their rent projections. So maybe they know something we don't. We're kind of still trying to be somewhat conservative in that area right now, but definitely uptick in deal flow, still kind of a bid ask gap. I would say before it was all like 20 25%. I'd say we're getting closer to like 10-15% to the ask or the whisper price on some of these deals. So anything else? Any input, Victoria or Praveen? What are you gonna see?
I'm good, thanks.
Yeah, I mean, I'm definitely seeing an uptick too, or we can barely keep up on underwriting them all, but we're still having the same issue. Like we put in 3 LOIs last week and we got beat out on all 3 of them because we're just, more conservative than most people. And I think a lot of it is coming down to that rent growth. I'm being super cautious on that. I don't want to end up holding the bag later. So
Yeah.
I think that there's just a lot of groups out there that aren't as concerned with that as we are.
Yep. I just attended a deal webinar and it was like I would say it was like very solidly a C asset, and their exit cap was 4.75. And I'm like, I just don't. That's really risky. Their deal was definitely back end loaded, not a lot of cash flow, but big returns on the end. They're doing like a 22% IRR, but it's because of the exit. So I'm
Wow.
like, yeah, we're not there.
Craig, I was negotiating an LOI last week in Fort Worth, and we had agreed on we had agreed on a number. I was flying down there. The day I was flying down there, while I was on the plane, the broker called me and said the seller, it was a distressed asset. The bank wasn't working with them. As I was flying down there, the broker calls me and tells me that the the bank approved their extension. And so he didn't want to sell it anymore. He wanted to take the risk and continue operating the property. And if he was to sell it, he raised the price by $2 million.
Wow.
Yeah.
Dang.
So these extensions are bailing these guys out, I think.
Mm-hmm. Yeah. How about you, Paul? What are you seeing on your side?
I kind of pivot a little bit and went more new development.
Oh yeah.
in trying to find just land deals. So I've slightly pivoted a little bit.
Got it.
Yeah.
Makes sense. Yeah, I think some people are cautiously waiting for that Fed pivot. Not sure how that's going to play out, but I'm optimistic though. Like I said, we're seeing a lot more deal flow. We're seeing a lot more sellers like coming to the table, like willing to at least start the conversation at the lower price. Yeah. Any other questions? Feedback? All right. Well, if there's nothing else, we'll go ahead and give you guys time back, and I'll start working on getting these videos uploaded.
Great. Thanks, Craig. Super helpful.
Thanks, Craig.
All right. Thanks, everyone. Take care.
Bye.